You walk into your bank. You ask for $10,000. It's your money. You earned it. You deposited it. The balance is right there on the screen. They tell you to come back tomorrow, not because the system is down, not because of some paperwork issue, but because the money isn't actually there. It never was. This isn't a scandal. It's not a glitch. It's how the system is designed to work, and most people have no idea. Right now, there's roughly $18 trillion sitting in U.S. bank accounts, checking accounts, savings accounts, money markets. That number shows up on millions of screens every day. People check it on their phones. They budget around it. They sleep better because of it. But if you added up all the physical cash that actually exists in America, bills and coins, you'd get about $2 trillion. That's not a typo. Roughly 90% of the money people think they have doesn't exist in any tangible form. It's not in a vault. It's not in a drawer. It's a number in a database. And here's the part that makes it stranger. The bank is legally allowed to lend out most of the money you deposit the moment you deposit it. So where did your money go? And what happens if everyone decides they want it back at the same time? Let's start with what happens the second your paycheck hits your account. You deposit $1,000. You see $1,000. The bank sees an opportunity. Under a system called fractional reserve banking, the bank is required to keep only a fraction of your deposit on hand. For decades, that fraction was 10%. In 2020, the Federal Reserve dropped it to 0, meaning technically, legally, your bank doesn't have to keep any of your money in reserve. But let's use the old rule to understand the math, because most banks still operate with some internal reserve ratio for safety. You deposit $1,000. The bank keeps 100. It lends out 900 to someone buying a car. That person's car loan gets deposited into the dealer's account. Now the dealer's bank sees $900. It keeps 90, lends out 810. That money gets deposited somewhere else. The cycle continues. $1,000 in physical deposits just became several $1,000s in the economy. Not because anyone printed more cash, but because the same base money got multiplied through lending. Economists call this the money multiplier effect. It sounds like magic, and in a way it is. The system runs on belief that most people won't ask for their money at the same time. Here's where it gets uncomfortable. If you and 9 of your neighbors all have $1,000 in the same bank, and you all walk in on the same day asking for cash, the bank has a problem because it only kept a fraction of those deposits. The rest is out there in loans, in mortgages, in credit lines that won't be repaid for years. This isn't a thought experiment. It's happened repeatedly. In 2008, customers of Washington Mutual tried to withdraw $16.7 billion in 10 days. The bank collapsed. Northern Rock in the UK saw customers lining up around the block. The images were surreal. Orderly British people in jackets and scarves, waiting hours to pull out their savings because a rumor started that the bank might fail. The rumor became a self-fulfilling prophecy, but those were dramatic cases. The quiet truth is that even healthy banks don't have your money. They have enough to cover normal daily withdrawals, enough to keep the illusion smooth. The moment that pattern breaks, the system seizes. Now you might be thinking FDIC insurance. The government guarantees deposits up to $250,000 per account. If the bank fails, you're covered. That's true, technically. But here's the catch. The FDIC's Deposit Insurance Fund, as of late 2024, holds around $120 billion. Total insured deposits in the U.S. over $10 trillion. That's roughly 1 cent of insurance for every dollar deposited. The FDIC operates on the assumption the banks do, that most banks won't fail at the same time. And historically, they've been right. The system works because failure is isolated. A bank here, a bank there, manageable. But when multiple institutions wobble simultaneously, when panic spreads faster than reassurance, that 1 cent per dollar starts to look terrifying. The FDIC can borrow from the Treasury. It has backstop mechanisms, but those take time. And in a bank run, time is the one thing no one has. It used to be that bank runs required effort. You had to put on shoes, walk to a branch, stand in line. That friction gave banks and regulators time to respond. Not anymore. In March 2023, Silicon Valley Bank failed in under 48 hours. Customers didn't line up outside. They logged into apps. They sent wires. They moved billions with a few taps on a screen. By the time regulators stepped in, $42 billion had fled. The speed of digital banking means the gap between rumor and ruin has collapsed. A tweet goes viral, a Slack channel panics, a Discord server spreads fear, and suddenly a stable bank is insolvent before the CEO finishes breakfast. This is the new risk. Not that the system is more fragile than before, but that the fragility reveals itself faster than anyone can contain it. So why does any of this matter right now? Because we're living in the longest experiment in cheap money and inflated balance sheets the world has ever seen. Interest rates were near zero for over a decade. Banks lent aggressively. Asset prices swelled. Everyone's account balance grew. Now rates are higher. Loans are harder to pay back. Commercial real estate is struggling. Regional banks are sitting on portfolios that lost value the moment rates climbed. Your money didn't disappear, but the assets the bank bought it with, they're worth less than they used to be. And if the bank had to sell those assets quickly to cover withdrawals, it would take a loss, a big one. Most of the time, this doesn't matter. Banks don't have to sell. They hold to maturity. They ride it out. But in a panic, when depositors want cash now, those paper losses become real. There's a version of this story where fractional reserve banking is celebrated as genius. It finances homes, businesses, infrastructure. It turns idle savings into productive capital. It makes the economy grow faster than it ever could on cash alone. And that's not wrong. But there's another version where it's a confidence game, a system that works beautifully until it doesn't, where your financial security depends not on what's in the vault, but on everyone else believing the vault is full enough. Both versions are true. The system isn't a scam, but it's not what most people think it is either. Step back far enough and you see the real architecture. Banks don't store money, they circulate it. They're not warehouses, they're intermediaries. The money you think is yours is a claim on future value, backed by loans, bonds, and the assumption that the music won't stop. The economy runs on velocity, not volume, on transactions, not treasure chests. And in that world, the question isn't whether your money exists, it's whether it exists when you need it. For most people, most of the time, the answer is yes, but the system has no plan B for most of the time ending. So the next time you check your balance, remember that number isn't a measurement, it's a promise. A promise that when you want your money, it'll be there. A promise that everyone else won't want theirs at the same time. A promise that works right up until the moment it doesn't. And the strangest part, the whole economy depends on you not thinking too hard about it.